What if you could secure your financial future without relying on a single source of income or a single type of investment? Diversifying your investments is one of the smartest moves you can make to protect and grow your wealth. Whether you're just starting out or looking to make smarter financial decisions, knowing how to diversify effectively can help you build a resilient portfolio. In today's video, I'm going to show you the top 8 smart ways to diversify your investments and make your money work for you, no matter what economic challenges lie ahead. Let's dive in. 1. Choose both short-term and long-term investments. When it comes to diversifying your investment portfolio, balancing short-term and long-term investments is crucial. Short-term investments, such as savings accounts, money market accounts, and treasury bills, offer safety and liquidity. They are designed to preserve your capital while providing modest returns. Long-term investments, such as stocks, bonds, or real estate, are designed to grow wealth over time. These investments tend to have higher risks, but offer the potential for greater returns through compound interest, dividends, and market growth. By choosing both short-term and long-term investments, you can balance security with growth. Short-term assets help provide financial stability, while long-term investments position you for future prosperity. This strategy allows you to take advantage of the stability of short-term assets while benefiting from the higher returns offered by long-term investments. 2. By index funds, mutual funds, or ETFs. One of the simplest ways to diversify your portfolio is through index funds, mutual funds, and exchange-traded funds, ETFs. These investment vehicles allow you to buy into a broad range of stocks or bonds with just a small initial investment. Index funds track a specific market index, such as the S&P 500, giving you exposure to a variety of companies across different sectors. These funds automatically provide diversification because they invest in a wide range of companies or sectors. For example, an S&P 500 index fund includes shares in the 500 largest publicly traded companies in the U.S., helping you spread risk while participating in market growth. The beauty of these funds is their low cost and accessibility. They are ideal for investors who want to build wealth without worrying about picking individual stocks. As you continue to contribute to these funds over time, they provide steady growth and protect you from volatility by spreading your risk. 3. Invest in a target date fund. Target date funds are an excellent option for investors who want a hands-off approach to diversification and retirement planning. These funds automatically adjust their asset allocation over time based on your target retirement date. When you invest in a target date fund, you select a fund that corresponds to the year you plan to retire, and the fund manager takes care of the rest, adjusting the mix of stocks, bonds, and other assets as you move closer to your retirement goal. For example, if you aim to retire in 2050, you would invest in a 2050 target date fund. Early on, this fund will have a higher percentage of stocks in its portfolio because stocks offer potential for higher returns over the long term. However, as the target date approaches, the fund begins to shift towards more stable and low-risk investments, like bonds, to reduce volatility and protect your wealth as retirement draws near. Target date funds are especially beneficial for beginner investors because they provide instant diversification across a range of asset classes. You don't have to pick individual investments or worry about managing your portfolio. 4. Invest in an asset allocation fund. An asset allocation fund is designed to maintain a balanced mix of different asset classes, such as stocks, bonds, and other investments. These funds automatically adjust the allocation of assets to keep your portfolio in line with your desired risk level and financial goals. Asset allocation funds, particularly balanced funds, are designed to give you a mix of growth and stability by investing in both equities, stocks, and fixed income assets, bonds. The main benefit of asset allocation funds is that they ensure diversification within a single investment. This can be especially helpful for those who want to invest in multiple asset classes but don't want to manage each asset type separately. Asset allocation funds are also a good choice if you want to reduce the risk of market fluctuations affecting your entire portfolio. This type of fund is ideal for long-term investors who want to ensure their investments are consistently rebalanced. By investing in a variety of asset classes, you protect yourself from the volatility of any one market segment. 5. Buy bonds. When interest rates decline, existing bonds tend to increase in value. For example, Let's say you hold a bond from company ABC that's paying 4% interest. This bond will become more valuable than a newly issued bond from the same company paying only 2%, as the older bond offers a higher interest payment. Bonds are known for their ability to move differently in value compared to stocks. This means that they can act as a stabilizing force in your portfolio, helping to temper your losses when the stock market experiences declines. Because of this, bonds serve as a great way to diversify your portfolio, providing a safe haven when stocks are underperforming. When it comes to bonds, there are several options to consider. Government bonds, for example, are issued by federal or local governments and are generally considered to be low-risk investments. Corporate bonds, on the other hand, are issued by companies and often provide higher returns in exchange for a slightly higher level of risk. 6. Add some individual stocks. While index funds and ETFs offer great diversification, individual stocks can help you target specific industries or trends you believe in. By adding individual stocks to your portfolio, you can diversify your investments in a more personalized way, based on your expertise or market knowledge. If you work in a certain industry, you might spot opportunities before others do. However, investing in individual stocks requires more time and effort for research and analysis. Picking stocks involves understanding the company's performance, the market trends, and the broader economic environment. While individual stocks offer potential for higher returns, they also come with greater volatility and risk, especially if your investments are not diversified across multiple industries. If you're new to stock picking, start by researching stable, well-established companies with a history of strong performance. As you gain more experience and knowledge, you can add riskier, growth-oriented stocks to your portfolio. 7. Invest in international companies. When looking to diversify, it's crucial to consider international investments. Focusing solely on U.S.-based assets can limit your opportunity for growth, especially if the domestic economy underperforms. By adding international companies or funds to your portfolio, you gain exposure to markets around the world, which may be performing better than the U.S. market at any given time. Investing internationally helps you tap into growing economies outside the U.S., such as those in Asia, Europe, and emerging markets. For example, China and India, with their growing middle classes, offer promising opportunities for investors. Similarly, Europe is home to many large multinational companies that can provide diversification and growth potential. You can invest in international stocks through global ETFs or mutual funds that track international markets or specific regions. This gives you access to companies that are often not available through U.S. exchanges. 8. Rebalance regularly. Once you build a diversified portfolio, it's essential to rebalance it periodically. Rebalancing involves reviewing your asset allocation and making adjustments to ensure it remains aligned with your financial goals and risk tolerance. Over time, the performance of different investments in your portfolio will cause the asset allocation to drift. To rebalance, you can sell some of your investments that have grown disproportionately and buy more of those that are underrepresented in your portfolio. Many financial advisors recommend rebalancing once a year, but some investors prefer to do it more frequently, depending on market conditions. You can also set a specific threshold, such as rebalancing if any asset class deviates more than 5% from your target allocation. Rebalancing is important to manage risk. By maintaining a portfolio that matches your desired allocation, you ensure that you are not overly exposed to one type of investment. It also helps lock in profits from high-performing assets and reinvest them into undervalued or underperforming ones. There you have it. 8 smart ways to diversify your investments and protect your wealth over the long term. From balancing between short-term and long-term investments to strategically buying bonds, these moves can set you up for financial success. The key is consistency, patience, and smart decisions that will compound over time. Remember, diversify your portfolio isn't just about reducing risk. It's about creating opportunities for growth across different sectors. Whether you're just starting your investment journey or looking to optimize your existing strategy, these steps can help you build a stronger, more resilient financial future. If you found this video helpful, don't forget to like, share, and subscribe for more practical financial advice. By subscribing, you'll stay updated on tips and strategies to help you make the most of your money. Thanks for watching, and I'll see you in the next video.